All right. Today is Sunday, July 16th. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. And folks, if you happen to be in the southwestern United States, you're probably sweating bullets right now. Not just because of the upcoming earnings season, but it is sizzling out there. Hot. I mean, look at this. Temperatures above 100 all over the place, above 90. It goes all the way to the south. Matter of fact, if we zoom out, pretty much every place in the US, the temperatures are above 80 degrees, with exception, of course, of Maine and North Dakota, aka South Canada. Now look at this. It says, hell on earth. Phoenix extreme heat wave tests the limits of survival. All of these Californians who moved to Scottsdale because, oh, it's cheap and I can work from home and create all of this inflation. Let's see how good you're going to survive this. And even in Vegas, the National Weather Service says not your typical desert heat. The hottest temperatures so far this year. No significant cool down overnight. No relief. 5 days, extreme heat. Die already. And look at this. 118, baby. Higher for longer. And of course, this was all predicted because back in April, they said that Nevada energy bills projected to skyrocket in July, even as natural gas prices plummet. And now we see extreme heat across the country, and natural gas prices are recovering. So you want to talk about reinflation? Here it is. Electricity costs will skyrocket this summer. And of course, they say that this is all because of El Nino. El Nino exacerbates global warming, record heat, record flooding, record wildfires. When do we get to Mars already? Elon Musk, get your shit together. He's on it, folks. He just got the Cybertruck done, so just give him a little time. By little time, I mean, I don't know, maybe 100 years or so. In the meantime, it is sizzling all over the place. Even in Italy, red alerts in 16 cities. And even Israeli Prime Minister Benjamin Netanyahu has been hospitalized for dehydration amid heat wave. It is brutal out there, folks, so stay safe. And of course, my heart goes out to the homeless and the animals out there. But also among the news that we got over the weekend, you might have heard this one. The most notorious serial killer in the 21st century in the US has been captured. The Long Island serial killer. Look at this man. Architect, father, husband, regular guy. I mean, he might have been a bully in high school, but regular guy. Turns out to be the most notorious serial killer in the 21st century in the US. And according to the cops, they got him while he was buying a ticket for the new Barbie movie. That was a telltale right there. If you happen to be above the age of 12, a male with no kids, and you buy a ticket for the new Barbie movie, there's a good chance you're a serial killer. But you know what, folks? You might want to watch this stock, MAT Mattel. It's been rallying higher based on the Barbie optimism, but it might go down a little bit, although my hunch says it's going to explode higher. It's going to become a meme stock. And the reason is, never underestimate the stupidity of human beings. This Barbie movie is going to be a hit. Led by single males, late 20s, early 30s, mostly Tesla owners, those kind of people. But you know, I always thought that the Long Island serial killer is going to be a Wall Streeter, Wall Street executive, an analyst. I mean, every time I see Mike Wilson on TV, I think, you know what, this guy could have played a good Dexter. And speaking of Mike Wilson, oh, it's tough to be a bear out there. And there's only two of us left, the last bears remaining, Mike Wilson and the Maverick of Wall Street. You know what it feels like to be a bear these days? It feels like Zelensky in a NATO meeting. But the good news for Mike, you know what? At the end of the day, we might see the Maverick top all over the place, all over the monthly charts. And I'm willing to share. I would say it's the Maverick / the Mike top. You look at the XLK, could happen here. Monthly chart. SMH, chips, could happen here too. Microsoft could see the Maverick / the Mike top. How about the chart of the Qs? Let it go higher, all-time highs. Then it goes down, forming the Maverick / the Mike Wilson top. But I have a feeling that Mike is going to capitulate this season within let's say about 2 weeks or so, because his whole spiel is, oh, earnings are going to be bad. I disagree. I think earnings are going to be okay. It's just that stocks went way over their heads, and they will act with disappointment because they're priced for perfection. My bear theory is that inflation is still here, and it will heat up significantly, and the Fed will have to act with higher rates for longer. In the process, something is going to blow up and the economy goes into a recession. But the problem with your beloved analysts on Wall Street, they're not just prone to serial killing. They're also addicted to drugs and hookers. They need to see the therapist all the time. They have to spend your money, the commission, baby. That's why you have to stay in the market. You know, got to stay in. So we can get the commission and we can, spend it on drugs and hookers and see the therapist. When they say, hey, time in the market is better than timing the market, really? Look at the chart of AT&T. Same price since 1994. So yeah, just stay in the market, don't time it. Just time in the market. Just stay in. Maybe someday you'll make it. Here's another one. Intel, INTC, never recovered the dot-com mania. Never. Time in the market. Maybe in 2100. Maybe Intel is going to recover. And I know what you're going to say, but Intel, that's a boomer stock maverick. Of course it's not going to recover. It's not NVIDIA. We'll go back to the 1990s. It was even bigger than NVIDIA. It was even more promising than NVIDIA today. So keep buying, folks. Keep chasing. They're going to go down, and you're not going to make your money back for 20 years, maybe more. But again, time in the market, right? Just stay there forever so we can capture the commission, 1%, 2%, sometimes 3%. Who do you think is going to pay all of these therapists? Do it for the hookers and the drugs, please. But I know what you're going to say, but Maverick, forget about AT&T and Intel. It's all about the index. Time in the index is what really matters. You mean this whole bull market that everybody's excited about? Well, all of what this bull market got you is back to even if you invested back in August 21. So 700 days. Now you're back to even. Time in the market. Just stay there. But folks, it wasn't just a bad week for Mike Wilson or the Maverick of Wall Street or the Long Island serial killer. Good company. It was also a bad week for Gary Gensler, aka Gary Coma. He can't touch the fraud in the stock market because it's done by his sponsors, but he tries to play tough in the tulip market. And unfortunately for him, it blew right in his face. This week, the judge ruled that XRP is not really a security, so Gary Coma should just shut up and get lost. And immediately, the tulip called XRP soared by more than 75%. And when it rains, it pours for Gary Coma. Now we have the U.S. Congress investigating Gary Coma and the SEC. Wow. It was also a bad week for Lina Khan. She lost to Microsoft. She wanted to block the acquisition of Activision. Did not work out. Now she wants to block ChatGPT. That's not going to work out. And her next move is investigating Elon Musk and Twitter. That's not going to work out. At some point, Lina Khan has to understand something here. You're trying to stand in the way of the rulers of this country, the owners. They own the judges. They own the politicians. They're gonna crush you. You better be smart and use your chairmanship of the FTC to make it easier for the criminals, all of these big companies, the oligarchs, to get bigger and richer. And then when you graduate from the FTC, get a job at Amazon, a consultant, whatever, and they'll shower you with $3 million salary a year. That's how it works. But maybe Lina Khan is too young to understand all of this. It was also a bad week for this Revlon owner who got an fender bender, and the repair bill was $42,000. That's the future Revlon. We have to stampede and buy the stock because it's going to change everything. But you get an fender bender, and it costs you an entire souffle. $42,000? You can buy the Model 3 with that. It was also a bad week for Mama Cathie Wood. See, she bought NVIDIA, but she sold before the rally. At least I didn't buy it. She sold exactly before the rally. And then she dumped Coinbase exactly before the pop. And you know what? When I read the headline, Cathie Wood, an ARK invest buy 82,352 shares of Facebook, aka Meta, today. That was on Friday. I actually told some of you that I have my yearly physical, and as the doctor was checking my testicles for cancer, the moment I saw this headline, I told my doctor, hold on a minute here, doc. I got a short Meta. And he said, you know what, son? I don't need to check your balls anymore. They work just fine. It was also a bad week for AI because, the $70 trillion AI. Looked at the case of a little girl who was suffering from abuse, and AI, the $17 trillion idea, said, you know what? I think she's safe. Well, she died from abuse anyways. So there you go. AI, changing the world, killing an abused kid one at a time. But anyhow, folks, let's get serious here and talk about the economy because, everybody been talking about recession. Where is the recession? Look at this headline. It says, the U.S. may dodge a recession, but slow growth to hit hard. Oh, I'm sorry. That headline was back from 2007. We don't think like this anymore, right? We take things seriously now because we learned from the past. Anyways, we look at the teams. You got in the bull camp, you got Team Soft Landing, then you got Team Pivot. In the bear camp, you got Team Stagflation and Team Recession. Who scored points this week? Let's start with the easy one, Team Pivot. The Fed already pivoted, and now it's about to repivot. The CPI maybe was a good point for Team Pivot, but they don't look pretty good now, and I'm going to show you why. Team Recession, again, it's the inevitable, but not right now, so they lost a lot of points this week. Then Team Soft Landing scored a bunch of points, and Team Stagflation did too. So right now, we know it's a battle between Team Soft Landing versus Team Stagflation. By the way, everybody's losing their minds right now. Even Mohamed El-Arian, who's supposed to be like a really wise economist, his greatest idea is, the Fed has to raise the inflation target to 3% to 4%. Where do we start here? If the Fed says, oh, we're going to raise the target to 3% or 4%, they're waving the white flag. And if they say 3 to 4%, in reality, you're giving inflation the room to go back to 5 to 6%. It's absolutely insane. They have to stick to the 2% target. There is no other choice. But folks, as I say, a lot of you are business owners, and a lot of you tell me and you say, look, throughout the year, business has been really horrible. Slow, nothing is going on. Then comes the month of June. Boom, business is hotter than ever before. What happened? The reason is the stock market rally. Everybody feels rich on paper, so they go out and spend. And the headline reads, Americans have not felt this good about the economy in almost 2 years. What are they talking about? Here it is. A commonly followed measure of consumer confidence in the U.S. economy just increased to the highest levels in September 2021. I wonder what happened back then. The first July reading of the University of Michigan Consumer Sentiment Index showed a reading of 72.6 on Friday. The print came in significantly higher than the 65.5 economists had expected and reflected a 13% increase the month prior. Listen to this. That marks the fastest pace since December 2005, when the economy was recovering from Hurricane Katrina. But here's the catch. See, the headline says U.S. consumer sentiment the highest in July since September, yada, yada, yada. There's a little headline down there that says inflation expectations tick higher. Here it is. July update, consumer sentiment showed uptick in the one-year inflation expectations from 3.3% to 3.4%, an uptick in the 5 to 10-year expectations from 3% to 3.1%. So 5 to 10 years from now, consumers say that inflation will be above the 2% target. Now, I've been saying, folks, you can't have your cake and eat it too. You can't say, oh, stocks are going to recover. My home price will recover. Manufacturing is going to recover. Everything in the economy is going to recover and boom again. But somehow, inflation is going to die. It's just in the past. It's over. It's transitory after all. You know, I saw a moron on CNBC on Friday who actually said that. Oh, inflation is transitory. He says, oh, we just had the recession back in 22. It's over now. We got the recession, now it's over. These are the kind of Wall Street analysts who are doing drugs and hookers and therapists. Just keep that in mind. Listen to this headline. It says Disney World's crowds shrink as competition and costs rise. Prices are going higher. Some consumers cannot cope with the increase. So you're seeing the stagflation right here. Here's more. Wage inflation. Inflation will never die, never, unless the underlying conditions of inflation die. Among them, aggregate demand and wage inflation. Look at this. United Airlines reached an agreement with pilots, a 4-year deal, up to 40% raises. 40% in wage inflation. Not to mention, of course, the looming and perhaps most threatening to the economy, the Teamsters strike in UPS. And now they're saying, hey, if it happens, White House, Joe Biden, stay out of it. We're going to strike, and it's going to be big, and it's going to paralyze the economy. It's happening all over the place, folks. Not just here in Canada, in Germany, in the UK, all over the place. And wages are rising higher and higher and higher. If you think wages are going to rise alone without bringing back inflation higher, I got a bridge to sell you. And you're probably buying a ticket for the new Barbie movie. And also in macro news, we got the headline that Biden White House canceled $39 billion in student debt. Now, A, there is no such thing as canceled. Somebody had to pay for that. A taxpayer had to pay for that. B, that's only 10% of the intended cancellations. So you have 90% of folks who have to repay their student loans come September. That's going to hit the economy really hard. And here's the question from the viewer. It says, I like your show, Mav. I know you've been a big proponent of the Fed keeping their foot in the gas pedal, hiking because you think reinflation. But don't you think this inflation has been because of fiscal spending, not bank lending that rates target? The Fed rate has no impact on fiscal. Now, we know that the root of inflation has always been the monetary policy. Because the idea is if the Fed raises rates properly, it's going to be really hard for the federal government to spend because they have to pay more in interest payments now, and that should choke spending. But the Biden administration already secured trillions of dollars worth of spending, and they have the audacity to call that the Inflation Reduction Act. And what we're learning right now is this kind of fiscal spending can actually keep inflation high in certain sectors. For example, construction. They're spending trillions of dollars. Wage inflation is sky high in construction. And if the sugar daddy is going to pay with trillions of dollars, then companies will charge more. So when I see a chart like MLM, for example, Martin Marietta, all-time highs, and somebody says, hey, Maverick, explain this to me, I can actually explain it. The sugar daddy has trillions of dollars, and Martin Marietta says, okay, you want me to do the job? I'm going to demand higher prices here. And the sugar daddy will pay. That's inflationary, but that's good for the margins of a company like Martin Marietta. So in a nutshell, to answer your question, the fiscal policy is not the source of inflation, but the fiscal policy makes it really, really hard for the Fed to get the job done. But Jerome Powell is too weak to even address that. He had the opportunity in the last FOMC, and he said, I don't do that. It's not my business. Well, your business is to tackle inflation down. The fiscal policy is making it really hard for you to do the job. It is your business. The Fed chairman should go to the politicians in Congress and say, you know what? You're making it really hard for me to get the job done. Get your shit together. Stop spending like a drunken sailor. But of course, Jay Powell will not do that. At least Chairman Volcker actually told Congress that. He knew it's not going to solve the problem. It's not the source of the problem. He still had to be really tough in the monetary policy. And of course, if the fiscal is not cooperating, then you have to be extra aggressive in the monetary policy. So if we thought that 5.5% would get the job done, now because we have out of control fiscal spending, the rate will have to go higher, 6%, 6.5%, 7%. And that's what JP Morgan CEO Jamie Dimon told us. You better be prepared for 7% interest rates. I don't think he's making that up. And he's still not convinced that a soft landing is guaranteed. Why would the top banker in the country say that? Just because he's a perma bear or he's doom and gloom? Of course not. He sees the data. He knows what's coming. And what's coming is this. We have a mountain of debt all over the place like we have never seen before in human history. And now we're talking about interest rates across the globe rising significantly higher. From 0 to 5% plus rapidly in less than a year. You really think that this is not an accident waiting to happen? And this is going to be the mother of all accidents. It's going to take decades to recover from this. But of course, right now, this moment, it's hubris. Everybody knows what's going on. Everybody sees the same data. But folks look at the stock market and say, hey, it's not going down. So forget about the recession. Forget about anything. Just keep going. Keep spending. Keep buying, keep chasing. And then when it happens, everybody goes, oh my God, yeah, the yield curve was not lying. The debt was not lying. Higher interest rates were not lying. All of these indicators that we've been talking about, they were not lying. But now it's too late. And that leads us to the stock market. And here it is. We talk about the icy hot economy. And unfortunately, there are absolute morons watching this channel right now. And they say, oh, Maverick, you're becoming bullish all of a sudden. You're capitulating. You know what? I'm going to offer $100,000 right now for all of these folks to have a free mental check. Just to check if the wires, if there's something wrong with the wires in your brain, maybe your hearing is not working pretty good, or maybe you're just plain stupid. I'll pay for the tests. What have we been talking about in this channel for the last few weeks? Reinflation. The risk of reinflation. Well, what is the risk of reinflation? In a nutshell, it's the categories in the icy moving back to the hot. And this process will support the rotation trade. So it is actually part of the bearish thesis. You've been crying and bitching and whining. Oh my God, I'm again. Because 7 stocks went higher. Okay, I'm telling you, stop chasing. You have opportunities in the rotation trade. That will not make you feel like you're missing out. Sure, it could be a transitory trade. In the meantime, it's working, and there are a lot of profits to be made here. And it is supported by the fundamentals, not just a speculative bubble. Because it is based on the premise that the Fed is not doing the job properly, they opposed prematurely. And this will cause the icy categories to move back into the hot and become inflationary again. The dollar is saying that. And therefore, these stocks, if you look at metal stocks this week, for example, oil stocks recently, a lot of them been moving higher. Not all of the categories, but some. And that's the premise behind the rotation trade. But not every rotation trade is made equal. If we look at the yield-driven rotation, meaning if yields go down, you're supposed to see a rotation to high dividend-paying names, into healthcare, real estate, utilities, and we talked about consumer staples. But so far, every time we see a drop in yields, they come back up. So this rotation hasn't been doing pretty good. It comes and it goes. And then we have the dollar-driven rotation. Now, this is supported by the fundamentals. We know that the dollar lost significant support this week. It appears that the chart is breaking down. No confirmation yet because Jerome Powell could come out next week and prop the dollar back up because he knows that a higher dollar is his best ally. If the dollar goes down, commodities inflation will come back. So we'll see what he does, but for now, we got to break down the dollar. And therefore, we saw Chinese equities doing pretty good. Certain consumer staples did pretty good. Commodities, energy, industrials, metals, they all did pretty good. That's the reinflation trade right here. And then we have the soft landing rotation, consumer cyclicals, the IWM, small caps, regional banks, retail. Again, this rotation comes and goes. It's not really on solid footing yet. If you look at the IWM all in all, a weekly chart, sure, there has been a rotation. But does it change the bearish trend right here? Does it turn the chart into a bullish chart? The answer is not yet. So we don't have the confirmation. You look at the XRT retail, it caught this rally, this rotation, but it did not change a thing. And the closing for the week was not really that good. If we see XRT going down, then there is no soft landing rotation. And it's a confirmation that there is no bull market. It's a bullshit market. It's a bear market rally. Get that through your head. But regardless of what happens to the stock market, we know that value will start to outperform growth. This is the Qs versus the SPY. Every time the chart trends down, we see value, aka the SPY, outperforming the Qs, aka growth. We saw this back in 22, but so far in 23, it has been all about growth. All about the Qs, all about the big caps, and the 7 AI stocks. But this trade is topping, and value is about to take over. Now, that doesn't mean that the SPY will go higher, the Qs will go down. They could all go down together. But it means that value will outperform growth, be it in gains or in losses. But my reading says that we will see value outperforming growth throughout this reinflation period in the summer, until the Fed takes this seriously and becomes aggressive, and then we could see both of them going down together. But understand this, a lot of value stocks have been already doing nothing at all, so they have already ate the loss. Which kind of stocks are under threat right now? The ones flying too high. The AI mania, the growth stocks. Those are the ones under threat. So again, we're heading into a period where value is going to outperform growth. And if you must be long anything, it's time to rotate from growth to value, at least a certain portion of the portfolio. Because even if the stock market crashes altogether, the value stocks will hold. And the reason is they've been doing nothing for half of the year. A lot of them are down. They've already faced some reckoning, unlike the growth/AI stocks. Speaking of, when we talk about a bull market, look at this. You take the S&P x the AI boom stocks. We're now at 3,900. We are still in a bear market. And all what we've gotten so far is a bear market rally. So when we talk about is it really a bull market or a concentrated bubble, the answer is clear. But this time around, the bubble is concentrated in the largest names in the world. And therefore, they're tilting these indices into the false premise that this is indeed a legitimate bull market. But then you open the hood, and all what we have is a bear market rally that hasn't been tested yet, but it's about to for the first time. You see, the only legitimate test that we've gotten so far is the collapse of SVB. Then came the Fed, plugged the hole. So far, so good for now. Now comes the test of earnings, and many more, but one step at a time. When we look at the SPX X technology, the SPXT, which includes Amazon and Tesla, but in lesser weighting. Again, there is no bull market here. And we know that the bear market rally went too high, too fast, too far. And it's due for the garden variety correction of 10%. Now, the 10% could become 20%, 30%, depending on what we step on. It could turn into a landmine. And the reason is we have the same conditions that preceded 1987 phenomenon such as Volumegeddon on the top of 2021. Among these conditions is sentiment. If you look at the bullish sentiment, it is way too high, and it appears that it has already peaked in the week ending July 5th at around 46.4%. Now, if you download the whole data, you can go back during last year, September, October. We can see that the bearish sentiment has peaked at around late September, early October. And this is what it's known right now as the October bottom, which will ultimately not be the bottom, but one step at a time. When we see peaking sentiment, usually it marks tops and bottoms, at least tradable top and bottoms. And if you follow this guideline, we have already peaked in the bullish sentiment, which means we have at least right now a tradable top. Now here's another important indicator, which is dumb versus smart money. This is a tweet from FX Evolution. I should read this in an Australian accent, but I'll pass on that. I don't think I've ever seen this chart so far apart. Now we enter earnings season and 45.30 has been reached. Now this is a classic sign of distribution, meaning the dumb money buys, the smart money sells, then the fundamentals come in play, and we have a lot of fundamental catalysts coming, such as earnings, and we see the dumb money looking around saying, okay, we did a dumb thing here, let's stampede to the exit door, and we get the flush down and the tradable top. And again, folks, when I say tradable top, I'm talking about a garden variety 10% correction. But could it morph into something more? The answer is absolutely. We have conditions such as the sentiment, such as huge shorting of the VIX, such as insane call options buying that could lead us into a volume get unlocked phenomenon. And a 10% becomes 15, 20, if not even more. If we look at the potential landmines, In July, we have big tech earnings. We have regional bank earnings coming out this week. We have the FOMC. We have the seasonality. We talked about this before. Again, I believe it's a voodoo science, but a lot of market participants believe in that. Usually, the second half of July is when we see the market deteriorating, and the top is usually marked by the end of the first half of July. And you can look at the candle, the closing candle that we got in the Qs and the SPY and say, okay, it seems that the seasonality is going to play out. We'll look at the charts in a minute, but we have upcoming VIX hedging. If we start to see that these earnings are becoming disappointing, you could see a lot of demand for the VIX all of a sudden. And that's when the risk begins. See, it should be 10% down, but if we start to see a stampede in the VIX, a lot of shorts covering, we could see a spike in volatility out of the norms, and what is supposed to be 10% down becomes 20 plus. And then we have the grain deal deadline. That's coming out on Monday. We'll talk about that in the commodities segment. But in August, we have July CPI. This is when the base effects are gone and the possibility of reinflation being priced in. We also have Apple's earnings. As Apple goes, so will the market. We have Nvidia's earnings. Most of this mania began when Nvidia gave us a number, the revenue guidance. If they fail to live up to that, it's going to be a problem. Then we have Jackson Hole 2.0. We have the beginning of the election season. In September, we have the FOMC rate decision. Right now, everybody says that September, it's not going to be a live meeting. What if it is, though? Then we have the seasonality in September, which favors bears over bulls. We have the student loan repayment. And then there's a mistake here, a redundancy. Seasonality, we already talked about that. But there is seasonality again in October. It's a bad month usually. And then we have the depletion of excess savings. Now, we could add to these potential landmines as we get them. But the point is clear. We're not out of the woods. Any of these factors could be a hidden landmine. What is the message of the day here? The answer is hedging strategies. The VIX is too cheap right now. Stop the arrogance, stop the hubris, and use some hedging strategies. The reason is, if you look at Microsoft's chart, for example, when do we short with both hands? Fundamental reversal, we don't have that yet. Technical reversal, we have the majority of these conditions because the RSIs are elevated. We have the double top potential. The mechanical reversal, the extreme call options positioning came and went. Now we see big unusual short bets in a lot of these names. We're just waiting for factor number one, which is a fundamental reversal. And that could be earnings. Now again, I'm in the school that says earnings are not going to be that bad. They're going to be okay. And the reason is the dollar is down. That alone is going to expand margins. The problem is, if we use the Microsoft example, folks are going to ask, okay, back when the price was trading at the same place back in 21, Microsoft was growing at a rate of X, which was pretty good. Double digits across the board. Now we have the same price, but the growth has slowed down markedly. Is it really worth paying the same price? That's when the thinking process starts to kick in, and we see the correction. It doesn't mean that the report is bad, but it means that the price is bad. And that's an important point. Now, if we look at the wall of hope, it's going to be an important week, a critical week. Number one, overnight, perhaps by the time you get this video, we're going to get a slew of Chinese economic data. And we know a lot of the rally was based upon China reopening. On July 26th, we get the FOMC decision. But before that, this week, we're going to get the ECB decision, but we're also getting retail sales, leading economic indicators, initial jobless claims here in the US. All of these are important factors for the upcoming FOMC. And of course, the big one, AI. Maybe not so much this week. We have Tesla, but I never thought that this is an AI play. It's just a crowd play. But the week after that, we're going to get a lot of technology companies in the AI arena. If they fail to deliver, this AI story and this AI hype will start to crumble. So we have to keep an eye on all of these factors. And this leads us to earnings previews. Let's start with the earnings that already passed last week. The big banks, namely JP Morgan. Now on paper, the earnings were pretty good, but then you dig in the details and you get a problem. The majority of the problem is in investment banking revenues. Not for JP Morgan, but more for Citibank, commercial real estate for Wells Fargo. Now for JP Morgan and most banks, the problem is going to be these new regulations and capital requirements by the Fed. You see, Chair Michael Barr came out and said, hey, we got to have new regulations here, new requirements. And that's going to choke the lending capacity in these banks. Therefore, Jamie Dimon came out and said the private equity giants are dancing in the streets over tougher banking rules. Of course, he'd love to see looser banking rules so these banksters can repeat what happened back in the days preceding the GFC. But he also has a point that it will be tougher for banks to lend. They're going to be more selective now, and therefore the demand will shift to private equity giants, maybe the smaller VCs. And folks, when you see reactions just like we saw from the Bank of New York Mellon, for example, look at this chart, daily chart, an absolutely horrific candle, erasing days worth of gains. What is the message here? We're talking about the Bank of New York Mellon here. 100 years plus institution. I've worked with them. Smartest people I know worked for the Bank of New York Mellon. They gave my clients the white glove treatment. Can you imagine if this bank collapses? I mean, what is the message here? The message is simply, we have a lot of problems in the banking sector and we're not out of the woods yet. The systemic risk event is coming. And this time around, it's not going to be SVB. It's going to be 10 times larger and it will be impossible for the Fed to plug. Which leads us, here it is, Tuesday, right off the gate. We could see fireworks because we have earnings from Bank of America, Morgan Stanley, Charles Schwab, Bank of New York Mellon. Here it is, on top of Lockheed Martin and J.B. Hunt. Lockheed is a good pulse for government spending. J.B. Hunt is a good pulse for the cyclical side of the economy. Wednesday, we have Goldman Sachs, U.S. Bank, ASML. Really important for chips. Las Vegas Sands, United Airlines, Tesla, Netflix, IBM. Thursday, we have Taiwan Semi. This will be a really important indicator for NVIDIA. We have FCX, Freeport, Johnson & Johnson, Ally, and Capital One, all involved in these subprime auto loans. And that could be a hidden bomb waiting to detonate. Then we have CSX, really important for the cyclical indicators. American Airlines, D.R. Horton. These stocks have been flying high. Can they live up to the expectations or not? Then we have Blackstone. As rates rise higher again, what is the systemic risk here? Friday, we have Amex. Really important indicator for the affluent consumer spending. We have SLB. Important indicator for oil services, and we have Comerica. A lot of folks would say a bank under threat. Others see it as an opportunity to buy. We'll see which one it is. So buckle up, folks. But before moving on, let's do the morning brief. Good morning. Bank earnings are out better than expectations, and right away we see yields firming. I see weakness in the SPY, QQQ, IWM coming due to overextended technicals. Yet the first thing I'll be looking at is JPM, and whether these pre-market gains hold or not because banks been rallying ahead of the print. I think we might see pre-market gains faded before the dips are bought, so I might take a quick trade intraday against JPM or XLF. And if you look at JPM right off the gate, it collapsed. If we look at the 15 minutes right here, top to bottom went down by about 3%. So there was a lot of sell the news here. Then we look at the XLF, same thing, top to bottom down about 1.5%. Again, sell the news. Likewise, NVIDIA is gapping higher again with overextended technicals, so I'll take a quick day trade to play the pullback. You look at NVIDIA 15 minutes chart, top to bottom, down about over 6%. Not quite sell the news because we did not have any news for NVIDIA, but it's just overextended. It's just insanity. Based on options, all expiring on Friday. Those who made their VIG, they're going to dump right away, and we see the opposite reaction. The good news is NVIDIA kept 450 as support, so until that's lost, we don't have a reversal here. On the other hand, it was a really good trade. Then the last one, I'm also watching HELE. This is for Helen of Troy. I think it's due for a pullback. This one will be a longer trade though. Now we talked about this name in a portfolio review and we did Helen of Troy versus Cody. And I said, look, I own Cody. It's okay, but maybe the opportunity is in Helen of Troy. And this was before the pop. So we got earnings. The name popped significantly higher. It got out of whack. It's due for a pullback. We got a down day on Friday, maybe more coming. But then at some point, you have to reconsider the stock. It is really cheap for now, and they did pretty good in earnings. So if it dips down, let's say it goes down to 120 or even below, maybe we should consider the stock as a long. Maybe. We'll see what happens. But right now, overextended, due for a pullback. Anyhow, folks, let's move on to cover the market information for you. We begin with the closing of the indices today, and here we go. On Friday, the Dow Industrial Average was positive by 113.89 points, or a gain of 0.33%. On the other hand, the Nasdaq was down by 24.87 points, or a decline of 0.18%. Likewise, the S&P was down by 4.62 points, or a decline of 0.10%. We look at these sectors on Friday. Finally, healthcare is positive, leading the pack, along with defensives. The laggards, led by energy, financials, and metals. So we have the rotation of the rotation on Friday. And my hunch is, as we head to earnings and we see de-risking, we might see these defensive sectors such as healthcare and staples outperforming. Yet when we contrast this performance with the weekly performance, as we can see, all sectors in the green, led by the dollar-sensitive materials. Because the dollar went down, now the problem is we're anticipating a rebound in the Dixie. So the trade this week could be fade metals, go long healthcare. That's the initial thinking for now. We'll see what happens. When we look at the breadth, we talked about the problem of the NYSE being really overextended, 70% plus, advancing versus declining for days. So it was due for us to go down to neutral, but The fact that it's been extended for days over 70%. Here's the reaction on Friday, 24% advancing versus 75% declining. NASDAQ, 28% advancing versus 69% declining. Could it get worse? The answer is yes. What could be the catalyst? The answer is how about regional banks' earnings? We look at commodities. What do we see here? On Friday, a little tick higher in the Dixie, but we talked about the old man gold predicting that we have a big rebound for the Dixie coming. Usually commodities react to that ahead of time. Then come stocks. So it is no surprise that we saw some commodities going down on Friday, led by energy, WTI, Brent all down by more than 2%. The gasoline RBOB down by about 1.5%. Heating oil down modestly, although natural gas was positive. We see mixed picture across the board. In metals, for example, we have gold, copper, palladium down. It's silver still catching some bid here, but it is becoming really overextended. You gotta be careful chasing silver here. Wait for a dip, then hop in. But all eyes will be on grains, and the reason is, here's the headline: Black Sea grain deal hangs on the 11th hour. We're talking about Monday. Either the Russians and the Ukrainians will come to a deal or no deal, and we will see wheat futures exploding higher. The reaction on Friday was wheat up about 3%. It could go back to the 700s plus if it turns out that we have a no deal. Now we'll look at the weekly performance all in all for commodities and futures. As you can see, canola, silver, platinum, soybean oil, corn, copper, lumber, all of them moved higher for the week, outperforming European stocks, the Russell 2000, the NASDAQ, the German DAX. And it was all in all good week for energy futures. The WTI, Brent all closing the week with gains north of 1%. We move on to the big casino options. What do we see here? The volume moved higher in the most popular names. Expected reaction? Sure. We have Friday's option expiration. We have the week pre-earnings. We have bank earnings. We have what some would argue a topping/reversal candle that we got on Friday. And you have to pay attention now. The volume is higher, but what are we seeing here? A little bit of demand coming for puts. Just a little bit. Could be a leading indicator that we will see puts outweighing calls as we head deep into the earnings season. So keep that in mind. And if I'm reading the tea leaves here, you look at a name like Tesla, IV rank about 21.5, Nvidia 18, Apple about 20, Amazon 40, AMD 37, Microsoft 44, Meta about 50. So we have plenty of room here to increase volatility significantly higher. And my hunch is, as the volatility increases higher in these names, it will increase on the downside, meaning we see negative reactions to earnings, and with that comes the increase in volatility. And at that time, puts are going to be expensive, folks. Catch them now before later. You gotta start hedging now. Buy the cheaper puts, lock in your gains. Don't get caught by surprise when your stock is down 20%, 30% after earnings. Then it's going to be really late to hedge. Let's look at the unusual activities that took place on Friday's action. And we start with the ticker COIN for Coinbase. We know why the stock popped higher. We got the ruling for XRP, but somebody's fading the rip here. Maybe Mama Kathy Wood. And they bought the 100 puts for the expiration date September 15th, with expectations that Coinbase will pull back and lose about 5% of its gains by the expiration date. They paid about $12.50 a piece. Tenor. This trade, all in all, spending about $12.5 million. Could be a bet in the downside. Could be somebody who went long Coinbase and they're hedging now. Then we have the triple Qs, somebody again hedging or shorting, buying the 359 puts for the expiration date August 4th, with expectations that the name will go down or lose more than 5% of its value by then. Paid about $1.25 a piece to enter this trade, all in all, spending about $1 million. At the bottom of the table, what about TSLA? While a lot of names went down on Friday's session, Tesla actually closed pretty much at the highs of the day. We'll look at the chart in a minute, but it's really interesting that they keep buying calls in this name. In this case, somebody bought the 320 calls for the expiration date August 4th, with expectations that the name will move higher and gain more than 14% by then. Paid about $5 a piece to enter this trade, all in all spending about $3 million. Now in a previous video for the members, we talked about hedging strategies for Tesla for both long and short positioning, and it cost you nothing, folks, nothing, and you get hedges for free. Go look back at that video. Then we'll move on to the heat map for the day on Friday. What do we see here? Honestly, nothing at all. Reactions based on earnings. The majority of the market was down. You see banks down across the board. A lot of de-risking in technology and chips. We see energy and metals down in anticipation of a rebound in the dollar. We see industrials also down. No demand for the defensives yet, such as utilities, real estate, although we started to see some demand for healthcare. Not all of them, but we see Eli Lilly outperforming. Of course, United Health popped higher based on earnings, but the chart doesn't look good. You got the home builders and the cyclicals such as D.R. Horton, Lennar. Those names remain too hot. You got some defensives actually moving higher based on PepsiCo's earnings, such as Coca-Cola, Monster Beverages, STZ, Costco, Procter & Gamble. But again, in anticipation of the dollar rebounding, you can see that the Chinese names pulled back. Alibaba, JD, Pinduoduo, and of course we got bad news from AT&T, and that pulled communication services down across the board. Some demand for technology names such as Google. We talked about the chart of Google. It looks at least good for now. Microsoft, similar story, above the 20 days moving average. Some software names such as Oracle, FT&T, those did pretty good on Friday. Now let's contrast this with the weekly heat map, and here it is. Green pretty much across the board. It doesn't matter what you played. If you chased the AI mania, you did pretty good. NVIDIA was up almost 7% for the week, so did Meta. If you played the rotation in industrials, in metals, in energy, in banks, in cyclicals, you did pretty good. But the laggards, really important here, we have AT&T, Verizon. Verizon is going down based on AT&T. So either Verizon is going to pop big once it reports earnings, or we got a problem in this name. Likewise, if you look at agricultural names in basic metals, you can see that FMC was down, reported earnings, was not good. And right away, we saw a lot of agricultural names going down, including Corteva, ICL, Nutrin, Mosaic, but we have more earnings coming from these names. We will see whether the damage is limited to herbicides, pesticides, or it is inclusive across agriculturals. Of course, we have an interesting contrast here with the stock of Deere, for example, moving higher, but then the actual resources stocks, they're down. Could be an opportunity, could be also a warning sign for Deere. Among the laggards, we also talked about ExxonMobil acquiring Burry, and that cost the stock about 2% for the week. Then we talk about, if you look at financials, insurance names were down, led by PGR Progressive Insurance, down over 11% for the week. Now, if you watch my portfolio review, I talked about my potential shorts. One of the names was Progressive. So a lot of the names we talked about in my portfolio review already moving, folks, and they're moving big. So either you're paying attention or you're not. Don't come to me and say, oh my God, Maverick, you didn't give us anything at all. You're perma bear. I give you names and tickers all the time. You're not paying attention. I gave you long tickers. I gave you short tickers. Among the longs, you saw what happened to Domino's Pizza, up big. Among the shorts, Progressive. Look at what happened to that name. So things are moving, folks, and I would say about 90% of you not paying attention at all. The attention capacity is about, I would say, 5 seconds max. And this is a 40 minutes plus show. Anyhow, moving on to the weekly heat map for the ETFs, here it is. Green across the board, rotation, no rotation, everything did pretty good. Now comes the test. If the dollar is due for a rebound, the gains for the GDX, for example, gold miners or SLV silver, energy, metals, a lot of the dollar-sensitive names, those gains will go down. Likewise, if yields move higher, we could see a healthy rebound here because the Fed is not going to cut rates. The Fed is not backing off, at least for the next FOMC. And we have retail, by the way, retail sales coming. So we have a lot of inflationary data that could spike yields higher. If that is the case, we could see, for example, real estate down. We could see especially the KRE going down. Maybe gains in, let's say, the XRT, rate sensitive, industrials, even technology going down. But I also see defensives outperforming. I'm not going to say they're going to shoot up higher, but outperforming. We're talking about XLU utilities. We're talking about the XLP staples. We're talking about the XLV healthcare. We'll look at the international markets. Huge gains for Chinese, FXI, MCHI, all based on the dollar going down. If we have the dollar rebounding, then the EEM will go down, FXI, MCHI, any of these emerging markets and Chinese markets will go down. So keep an eye on those. Let's do charts and then wrap it up. We begin with SPY, an hourly chart. What do we see here? We got what it appears to be a gap and crap on Friday, opening higher, getting a rejection from 451, closing at the lows of the day below the gap. Some would argue that this is a reversal pattern, but on the other hand, we don't have a confirmation. Confirmation would be losing support at 446.5 or closing below the lower gap. The bulls would argue that this could be a pullback in an ABC pattern. Next thing you know, we're back at 454. The bears would counter and say, but look at the momentum indicators. Look at the RSI, look at the MACD. They suggest damn we go to 446.5, and we bet that this support will fail. And next thing you know, SPY is down to 443, and then we take it from there. To settle all of this, we look at the futures, E-mini futures daily chart. What do we see here? We have a pattern of higher highs and higher lows for now. This gives the advantage to the bulls. Is the closing candle ugly? The answer is absolutely. It was preceded by 3 white soldiers pattern, but there was no follow-up. We got a reversal candle instead. Now, the confirmation would be making a lower low. But we're far from there, so we have to take it one step at a time. Support number 1, 45.09. Support number 2, 44.72. You gotta break some of those, and the ultimate confirmation would be losing 43.84.50. We're a long way from here right now. The momentum is stopping, sure, but you need to start to see these support lines being lost before the momentum is changed. And the good news for the bears, we talked about the SPX, the cash index. You have a clear trend line, support and resistance. Oh, we've hit it again. We got stopped before a few weeks ago. Now appears at least, we got stopped again. If we start to trend down from here, and let's say we lose 44.09.60, that's my number. Your number could be different, but most importantly, and the ultimate confirmation, we'd be going down to 4,300 and losing that support. Then we're done with the bullish trend. Here comes the bearish trend. But understand, between now and then, we have a lot of cushion to crack. It's not going to be easy. We clean up the chart a little bit and zoom in, use the Bollinger Bands. What do we see here? We're out of the boundaries. We need a pullback. Target number 1, 20 days moving average, which is coinciding with 44.09.60. That'll be a downside of about 2%. If that doesn't hold, then we go down all the way to the next support, which will coincide with the lower Bollinger Bands at 4,300. That would be a downside of 4.5%. We look at the Qs, 30 minutes chart. What do we see here? Again, we can use the bullish argument that what we got on Friday is just a pullback in a larger ABC pattern, which will take us all the way back to 390. But the bears will counter and say, look, the momentum indicators, be it the RSI, the MACD, they're all trending down. And we closed below support at 379. Even if we get a gap in the morning, it's going to be a gap and crap. Or we could crap right away, opening down to revisit 373.82. If that doesn't hold, we have the gap below. And after that, we go back to 370. To settle all of this, we have to look at the daily chart for futures. What do we see here? Folks would argue that this is a morning star, shooting star, whatever you call it, doesn't matter to me. The point is clear. Opening higher, closing at the lows. Reversal? Sure. Confirmation? Not yet. What will be the confirmation? Losing 15,500 as support. But even if that happens, folks, there is no trend reversal until we get 15,000 lost as support. Momentum indicators overstretched. They support the bear thesis. Keyword thesis, but the momentum is still with the bulls. Now we look at the NDX, the big NASDAQ, daily chart, Bollinger Bands. What do we see here? We talked about the overextension. Last time we got a 10% almost worth of a correction. What about this time around? If you believe that this was a topping candle and down we go, then we have the 20 days moving average. That would be a downside of about 3%. If that doesn't hold, then we have to go down to closing the gap, and that would be a downside of over 10%. Why would that happen? The answer is earnings disappointment. And folks, let's be honest here. We desperately need this because the sentiment is out of control right now. Folks are talking about all-time highs. Folks are talking about, oh, the recession doesn't matter. The recession already happened last year. Higher for longer by the Fed doesn't matter. Inflation is dead. Sky is clear. And everybody's stampeding in a really dangerous kind of behavior. If you go down 10%, erasing the gains for the month of June and July, then you're going to see a different tone. Folks are going to start to be more reasonable, more logical, and more disciplined. And that is desperately needed right now. And then we're going to reassess, folks. We look at earnings, we look at the macro conditions, we look at the inflation indicators, the path for the Fed policy. And then you got to decide. If you're bullish, if you believe in the AI stocks, if you believe that the worst in terms of economics is behind us, then you're going to get better prices to buy. You're going to buy the dip at better prices, and higher we go again. But chasing right now is a fool's errand. IWM, small caps, Russell 2000, what do we see here? On Discord on Thursday, I said I'm going to short the IWM. Didn't give specific numbers, didn't give anything. You guys, because the majority of you are smart, you know what you're doing. A lot of you bought the 190 puts in the IWM. Lots of you bought the 192, sold the 190. You structured the trade the way you see fit, and you got rewarded right away. Big flush down in the IWM. It was overextended to begin with, and now it's forming a bear flag pattern. Next support we have is 189.57. That will be closing a gap below, and then we see what happens. Like I said, if we look at the Bollinger Bands daily chart, we clean it up here. The last time we've seen such divergence from the Bollinger Bands, IWM went down by about 16%. Not saying it's going to go down by 16% from here, but we got regional banks earnings coming up. We could see the banking chaos coming back. If that is the case, target number 1 would be the 20 days moving average. That would be a downside of about 4%. If that doesn't hold, we could go down all the way back to closing the gap. And that would be about 9.5% downside from here. From the top of the Bollinger Band. Now, if the IWM goes down by this much, forget about the rotation trade, forget about the bull market. The bears will start to regain control decisively. All what it takes, folks, is a downside of a little under 10%. That's all what it takes for all of this bullshit talk about a bull market to change. This bear market rally, keyword bear market rally, hasn't been tested yet until now. We look at the Dixie. What do we see here? Daily chart. Oversold in the RSI. Oversold Bollinger Bands. Oversold MACD. Due for a big rebound. And this rebound could take us all the way back to 102. If that happens, there'll be lots of pain in commodities, lots of pain in the stock market. But the problem for the dollar is if we zoom out to a weekly chart, what do we see here? Sure, we can get a reaction, a reflex, but then what? I think the weekly chart has spoken and it says down it goes. So we could see a rebound and then down it goes again. What does that mean for gold? The old man, here it is. Bullish, sure, but could it pull back all the way in a retest to 1928 and then rebound higher as the dollar goes down again? The answer is yes. So the point is, don't chase. You're gonna get a better price here. Same goes for the SLV silver. Big pop for the week. But is it due for a pullback? The answer is yes. We plug in the Bollinger Bands, we clean up the chart, here it is, above the boundaries, due for a pullback, maybe it closes the gap altogether. So don't chase here, wait for the dollar to rebound. If it fails and it goes down again, that's your signal that if you did not get an SLV before, you can get in now. Here's the weekly chart, again making a higher low, so this is a positive development here. And it indicates at some point SLV is going to crack above the channel. The question now becomes, do you buy at this point or wait for a pullback? My answer is wait for a pullback. If you're not in it, there's no point of chasing right now, going down 5-6%, and then it rebounds higher. Just wait for the dip to happen, then hop in. Same goes for the daily chart for Brent oil. What do we see here? Big reversal candle here, engulfing candle. And if the dollar is due for a rebound, we're going to see oil going down. The test becomes, can Brent oil keep 77 as support? And then as the dollar starts to turn back down again, can we see Brent oil catching a bid and rebounding higher? That would be an excellent ABC pattern, a bullish pattern that will take us to higher highs. Then what about the 2-year? What do we see here? Reversal candle on Friday. Yields are popping higher again. And the market did not like that. So higher for longer, folks. We know Jerome is a pussy, but at the end of the day, he's not in charge. Inflation is. And the chart of the 2-year is saying, whether Jerome likes it or not, he's going higher for longer. We look at the TLT. Not a good rebound here. Did not even make it above 103.5. It's already back inside the box. What does it say? It says, once again, yields are going higher. And don't forget, folks, we have the deluge by Janet Yellen. All of these treasuries all of a sudden are going to hit. And that's going to happen soon. That could be a landmine, which means yields go higher, bond prices go down. What about the VIX daily chart? What do we see here? The good news is, it appears that it is making a higher low. The bad news is, it is struggling to gather momentum. We need a legitimate episode of fear. That could come from bank earnings, that could come from technology earnings, that could come from the seasonality, it doesn't matter where it comes from. But the demand for the VIX has already bottomed, in my opinion. Are we going to start to see more demand for hedging? 30 days plus, and the VIX will make it above 17. Apple, the big kahuna, the laggard for the week. But will it be the outperformer this upcoming week? Well, the hourly chart suggests so, and the reason is we have a breakout above the sloping line of resistance. And we have a closing above it, so that's the good news. Bad news. We zoom out to the daily chart, we plug in the Bollinger Bands. We got the pullback that we were looking for, from outside of the boundaries of the Bollinger Bands all the way down to the 20 days moving average. That's done now. We got a rebound. And the chart says indecision. Doji after doji after doji. It means a big move coming for Apple. That could be up or could be down. Now, the fact that we're above the 20 days moving average, the fact that in the hourly chart we're above the sloping line of resistance, the odds say the pop will happen higher. But the chart is saying it's not sure. If you look at this chart, the daily chart, it's saying I'm not sure. I got the pop. I got the rebound from the 20 days moving average. But there is no follow-up here. Nobody's buying Apple for some reason. If the buyers don't show up, the sellers are gonna. They're gonna de-risk ahead of earnings. Down it goes. If it breaks the 20 days moving average, then we have a bullish to bearish reversal. Here's Tesla. Hourly chart. What do we see here? We talked about the inverse head and shoulder. We talked about 276.47, important support. Tesla closed above. Who has the advantage? The answer is easy. It's the bulls, not the bears. And if you happen to be a day trader, it gave you an opportunity here, a really good opportunity during Friday's session. You see the double bottom that we got at around 276.47? That's your indicator that this is solid support for now. Then the chart moved higher, making a new high for the day. That's your signal right there to buy Tesla. You traded all the way until the RSI becomes overbought in the 5 minutes. That gave you gains of about 1.7%. You dump it, say goodbye, you go to the beach for the rest of the day. Now, what about the larger time frame? Do we see Tesla higher or lower? The answer is so long as it's trading above 276.47, the bulls have the advantage. But we have an important catalyst coming this week, earnings. We have already priced in the deliveries and the revenue side, so the top line is already priced in. Now it comes to the bottom line. Now it comes to the margins. If the margins come out good, the stock will be above 300, no doubt about it. If the margins come out bad, you will see an oversized reaction to the downside that could take the stock to 250, if not even below. So we have a big move coming for Tesla here. Then looking at AMD, because we talked about AMD in the last video, we talked about it in Discord as a long trade for Friday. We got the pop higher. It gave you about 5% worth of gains. It got all the way almost to the resistance at around 122.5 and the upper Bollinger Band. And then it reversed down in what it appears to be a reversal candle. So the message of the day, folks, in these kind of trades, always be closing. Now, we look at the momentum in the daily chart, RSI, MACD, they all appear to be bottoming and moving back toward the bullish side. But here's the problem. If we zoom out to a weekly chart, which is more significant than the daily chart, what do we see here? The bullish momentum is topping. We have a formation of a bear flag pattern. We have an important support at 108.27. We have an important trend line here. If the bear flag play out, and we see a loss in momentum in the weekly chart, AMD will go down to the trend line, and that could be a loss north of 17%. The fact that the daily chart is showing a topping signal could be a warning sign that the weekly chart is about to play out. So again, it was a trade. You made 5% right away. No reason to be greedy. In terms of options, you probably made over 100% worth of gains. Always be closing. And then here it is, Microsoft weekly chart. A lot of you asking me for Microsoft. I mean, it's a double top right now. Weekly chart stalling. It's all about earnings. The earnings come out not in perfection, because this is what the stock is pricing in right now. If earnings are not perfection, down we go. We break the trend line, or we mark a double top. You look at the monthly chart. You have a potential for the maverick top. We'll see what happens. And then we have Ryan Rapucci, who says, can someone who can't afford the membership that allows you to speak in the big house, aka Discord, could you suggest an ENVX chart, excuse me. First of all, it amazes me, I'm not talking about Ryan here, I'm talking about other folks, who say, Maverick, hey, what do you think of this trade? And I see the guy trading like weekly options, zero DTEs, with hundreds of thousands of dollars. But somehow pitching in $10 is too much. That one you gotta think about. But gambling $100,000 in a stupid trade, that's okay. Anyways, lucky for you, my friend, a lot of folks been talking about Innovix for a long time in Discord. I don't know who pitched the idea. Maybe some other YouTuber or some guy that you guys follow. But I've been getting questions about, what about ENVX, Innovix, for months now. And the chart never really moved. And I say, look, the chart is stalling. There's nothing to see here. Then in the month of June, we see the chart popping higher. And preceding that, we saw some unusual activities in the options market. Okay. Now, what do we do here? Daily chart overextended in the RSI, MACD. It appears to be running out of momentum, running out of gas. We have earnings coming out. We could see de-risking ahead or before earnings. That could take us back to the support zone that I'm marking right here. And then it rebounds higher. You want to see it going down first, catching this support and rebounding higher. If it does, you should go long. If it fails this support, then you gotta double down the shorts. I don't know why you're asking. Maybe you want to short it right now. If you do, you gotta do it via increments. Batch number 1 right now. Batch number 2 after earnings. Batch number 3 if you see this support broken. And last but not least, what about Bitcoin? What do we see here in the daily chart? Stalling, nothing is happening here. But folks, you have to read the psychology. Bitcoin got everything it was looking for. The dollar went down big this week. Number 2, we got the ruling for XRP. Every other tulip moved higher, with exception of Bitcoin. In my book, this shows weakness. This shows lack of enthusiasm. I'm not saying the chart is going to break down. For now, looking at the technicals alone, it's just consolidation, and we'll see what happens. It's a gathering of energy. It could pop big to the upside, and we see a lagging reaction, or it could flush down back to the consolidation range, the original one. What do you do here? I already got out of Bitcoin. We got the pop. Once we got 30,000, got out. There's no reason to hop in right now. You gotta see the break one way or the other. Break down, you short. If you have a breakup, you chase. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? We have plenty. Monday, we have the Empire State Manufacturing Survey. Tuesday, the 18th, we have retail sales. We have industrial production, capacity utilization, business inventories, and the Home Builders Confidence Index. Wednesday, the 19th, we have housing starts. Thursday, the 20th, we have initial jobless claims. We have Philadelphia Fed Manufacturing Survey, along with existing home sales and U.S. leading economic indicators. We have nothing on Friday, July 21st, but it's going to be all about earnings, folks. So buckle up, and we're going to cover all of these earnings in this channel, so stay tuned. With that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Hold my ice cream, Ken. All right, Ken, you're on. Let's beach off.